So what's the difference between a primary resident and a rental resident when you're converting it? Let's say you have live in your home and now you want it whether upgrade, downsize, right size, and now you no longer live in that home, but you still want to gain the benefit of appreciations and you still want to get the cash flow. So you decide to put it up for rent. Well, what is that like? It's actually a pretty straightforward process because it's essentially you're converting your home into a business, right? What we consider a rental is a passive business, but it's IRS still consider it a business. So anything relating to the operation of this business or this rental is going to be deductible, right? And everything, all the income that's coming in from this rental is going to be taxable. Any rent that you receive from it, any bonus that you might have received for renting to certain type of tenant, any incentive, any sort of, let's say, application fee or whatever fee that you charge, that is considered an income. The only thing that is not is the deposit. However, there's different way of accounting for that. If you don't count it when you receive it, you don't count it when you return it. But if you count it in as an income, then when you return part of it, then you can count the deductions of it. But that's a little bit of exemption. And when it comes to expenses, all expenses relating to this rental property is going to be deductible, right? So if your mileage driving from wherever you are to this property costs you gas, right? It costs you insurance, it costs you the car, so you can deduct that. Or you can just count the mileage and do a per diem for it, right? And your insurance, the cost of repair, utility, gardening, pest control, property manager for it, advertising to find a tenant for it, everything relating to this property is now deductible. Whereas before, when you're living it, you can't really deduct anything. However, if you have a primary resident, I will say this, that if you have a primary resident, it's important to keep record, right? The record, your final statement when you purchase the home, you want to keep record of all the remodeling, not repair, right? So whenever you repair something, it has broken, now you repair it, it doesn't count. That's considered an expense. Whenever you have something and you're upgrading the quality of it, then that will count. You can actually deduct that in the future when you sell it as a primary resident, right? So let's say if you, the windows are really old, it's been like 20 years, you're gonna decide to upgrade the windows. So then the cost of that window, you can actually keep all the receipt. And in the future, when you sell it, you can deduct the cost of that. You can deduct the cost of replacing the roof. You can deduct the cost of remodeling the kitchen, the cost of upgrading your bathroom, things like that. So you want to save all of those receipts or those invoice so that when you sell, you can deduct that. However, if the home is a rental, then all of those can be deducted sooner, right? Because if it's a repair, right? Somebody throw a rock at your window, it broke, that's a repair. You deduct it that year. If the window is old and now you're upgrading it, now we can deduct it through what we call depreciation. So we will look at the cost of it, and then you can deduct it over a certain number of years. So you can deduct it right away in small pieces. And really depend on the type of expense. There are a different number of years that you can deduct. But then now we're getting a little bit complicated. So that would be for another time in another video. What is the tax implication of owning multiple property across different states? It does get a little bit more complicated, but it's not too complex because when we file a tax return, right, we file the federal tax return, which they don't care where your property is as long as it's within the US, it's in their jurisdiction. And then we file the state tax return. The state is dependent on the state where you live. But let's say if you decide to invest in Arizona, Nevada, Texas, right, then now your tax return is going to get a little complex because now you have to file your California tax return, and then you also have to file your Arizona tax return. And again, Nevada doesn't have state tax, so you don't have to worry about that. However, the California will want to know what you have outside of state as well, and depend on what it is, they usually do tax you on that income as well, because your resident is within California. And I would say when you get to the point where you have multi-state investment, it's best that you talk to a CPA, not just a tax filer, because now you're probably gonna want to have more. You want to have somebody that can do planning with you too. And usually, before when I was working in an accounting firm, I know like every December, the lead partner would get very busy because that's the time where he's meeting with all his clients. They're doing planning session. They're looking at how much taxes they're expecting for the year, what is going to be changing next year. So you definitely want somebody who is a little bit higher level and not just rely on TurboTax, because TurboTax asks you a question. If you don't understand a question, you answer it wrong, you're gonna get the wrong answer from them as well. Not to say they do a great job. I use them as well. So can you offset your real estate passive loss against other income? So your rental gain and loss can offset each other, right? So let's say if you have multiple property, one have a gain, a profit for a year, and then you bought a new one and the new one had a loss for the year, that can net against each other. However, you cannot take, let's say you done really well for real estate, you make a ton of money on that, your stock market tank, you cannot take the loss from the stock market and net it against the rental gain. It's different thing. It needs to be like kind in order to net against each other. There is a way where if you are an active participant in the real estate, then there is an additional level where you can deduct it. However, I feel like if you get into real estate, it is to make money, not to lose money. Although, when you first buy them with depreciation and things like that, it's more of a paper loss and not a true cash flow loss. So, and that's part of the reason why too, a lot of people do buy you want to acquire new property, because that depreciation you have a bigger depreciation in order to offset other property that you have purchased in the past and are now cash flow positive, and it also showing positive on your tax return.